What's up everyone, it's Kadi with MoneyVest. So in this video, we're going to be talking about the important week that's coming up. The earnings season's getting started, and more importantly, the inflation numbers are going to be due next week on Tuesday and on Wednesday, and I will be live both of those days to cover the inflation numbers because CPI and PPI is scheduled, and that's probably one of the most important metrics that the Federal Reserve is focusing on and is going to be looking at when it comes to essentially writing out a path to monetary policy when it comes to interest rates. So hope you all enjoy this video and find it helpful. I would really appreciate if you drop a like on this video and of course subscribe to the channel if you haven't already. The links to our Discord and Patreon is going to be down below if you're interested in joining us. We've got tons of MoneyVest member benefits, including our private videos and tutorials, including trade alerts and trade ideas. And we do also have the MoneyVest.com platform with the beta launch happening very soon. We're just having some delays with respect to the development, but we are going to be creating a lot of amazing features for all of our members to do full fundamental analysis and of course use our financial models and calculators to calculate intrinsic values and price targets for stocks yourself. So again, link's going to be down below if you want to join and of course be a part of our community and of course get early access to the beta launch. So this right here is the earnings calendar. And we are going to be getting started here with the earnings here fairly soon because April is here. The first quarter of 2024 is over. And now we're going to start hearing from all these companies with respect to the earnings for the first quarter 24. So as April gets started, Tesla is going to be reporting at the end of this month. But we do have companies like Delta reporting here on Wednesday before the market opens, as well as some of the banks. Banks are some of the first companies to report. So again, Delta is going to be before the market opens. And then we got Wells Fargo, JP Morgan, BlackRock, Citi, and State Street. All these companies reporting on Friday before the market opens as well. So banking really kickstarts the earnings season almost always. And some of the biggest ones in the US are going to be reporting on Friday as well. So very, very important earnings season coming up, along with the most important catalyst, which is indeed inflation numbers scheduled for next week. So actually Wednesday and Thursday is when we have the numbers coming out. So first of all, Monday we've got FOMC member Kashkari speaking again. He did do a lot of damage earlier in the week here because he did mention and he did talk about something that most members haven't really said out loud, and that is that if inflation continues to be above the Fed's target of over 2% and the economy continues to push higher with very strong economic growth, there's a possibility that the Federal Reserve does not cut interest rates at all in 2024, which obviously sent the markets basically all the way down. There was a pretty significant sell-off in the markets when Kashkari was talking. And of course, we did have Jerome Powell also talking last week. We did also have the 3-year note auction scheduled for Tuesday, April 9th. And then, like I said, the most important catalyst, which is going to be the CPI numbers and again, inflation numbers, headline inflation, month-over-month inflation, and core inflation, which is the Fed's preferred measure of inflation, which is also the PCE, came out last week, I believe. But this right here is the consumer price index. A little bit of a different calculation, but these right here are going to be the expectations. 3.7% expected. That's going to be down from 3.8. Month over month for March expected at 0.3%. That's going to be down from 0.4%. And again, CPI month over month. Headline expected at 0.3%. And core year over year, actually headline year over year, we're expecting to be at over 3.4%. So again, still significantly above the Fed's target of 2%. So core sitting at 3.7 year over year and headline sitting at 3.4 on a year over year basis. That is what the expectations, I believe, is going to be because the forecast is going to be on this column and the previous number is going to be on this column. So it's kind of interesting that the market is expecting for headline to actually go up compared to the previous number of 3.2 and for core to slightly go down from 3.8 down to 3.7%. So we are seeing a little bit of an increase. And now also 10-year note auction takes place at 1 p.m. Eastern on Wednesday. We talked about this in one of my previous videos. I kind of broke down the entire calendar and all the note auctions that are going to be taking place. Really, really important metric to look for here is the bid to cover ratio, because that essentially tells us how strong the demand was, because the 10-year yields have been pushing higher. Wolf Street also covered this report last week, I believe, and they talked about how the 10-year yield continues to push higher on the back of this oversupply and the lack of demand. The yields are pushing higher, which is obviously putting more and more pressure on equities. So you got to keep a close eye on how this auction basically ends up going, because if the demand is not strong enough, there's again excessive supply, That's going to bump up the yields a little bit higher, push the prices down. It's going to put more pressure on overall equities as well. PPI numbers are going to be scheduled for Thursday, April 11th. So again, PPI numbers come out on the same week as CPI. And core PPI, we're looking at 0.2%. Month over month headline PPI, we're looking at 0.3%. And right now, we don't necessarily have the year-over-year number and the expectations, but we do also have the 30-year bond auction taking place at 1 p.m. Eastern. So we got the 10-year and the 30-year bond auction with a 4.33% awarded yield last time this auction happened. And the FOMC member Bostic is also talking, and of course, the balance sheet comes out every Thursday after the markets close at 4:30 p.m. Eastern as well. So we got a few more members talking. Williams is talking. Kashkari is already mentioned before. And then Bostic also talking at 1 p.m. Eastern on Thursday, April 11th as well. Now, we also do have consumer expectations, consumer sentiment, inflation expectations, all that stuff, which are Michigan University reports here. So 1-year inflation expectations, 5-year inflation expectations, consumer expectations, and the sentiment for the month of April, 79, which is again significantly increased from the previous readings. And then, of course, we do have FOMC member Bostic talking again. Jerome Powell is not speaking this coming week, but of course he did talk. He has been talking a lot over the last 2 to 3 weeks here. The testimonies in front of Congress, the FOMC press conference in front of the Monetary Policy Committee, and again, just more and more speeches have happened from Jerome Powell, and every time we've heard the same thing, and that is that they need to have greater confidence in order to be confident, so that they can start cutting rates, and they are going to employ this data-driven approach, and they're going to be looking for more and more evidence. So this right here was from Wolf Street. Nothing in the jobs report indicates that the Fed should cut interest rates. So this is something that, again, we have discussed in the in our previous videos, and I wanted to go over the jobs report more specifically because it came out very, very strong once again. So if I plug in the numbers into my unemployment report here, what you'll notice is, once again, a very, very strong number. So if I go over to the unemployment numbers itself, so this right here is going to be the employment number from last Friday, which was the first Friday of the month. And we got non-farm payrolls month-over-month increase of 303,000 jobs, which again is a significant increase on a month-over-month basis. Unemployment rate was at 3.8%. So again, if you do the calculation, and let's just go over to BLS website, and we're going to go over to national unemployment rate, and we're going to go over here the charts. And what I'm really interested in here is the unemployed civilian unemployment, right? Meaning how many people are actually unemployed in the US based on a actual number. So 6.429. So we're going to plug this number into our spreadsheet. So that's unemployed persons over here. 6.429 was that number. So 6.429. And then we're going to be looking at the JOLTS numbers, which also came out last week. So I'm going to go back over here, and then we're going to plug in the JOLTS numbers, which were, I believe, a little bit softer than what the consensus was. So 8.756. So we're going to plug in 8.756. And now this ratio is looking at 1.36 at the moment, right? So that is where we are with this ratio, because this number has obviously come down from 2.5, meaning there were significantly more job openings compared to unemployed persons. But now this number is now starting to get closer and closer to equilibrium. And that's exactly what the Federal Reserve wants. We want this number as close to 1 as possible, because that tells us there is equilibrium between job openings and unemployed persons in the US with respect to the labor market. But 1.36 is still showing a very, very tight labor market to begin with. Now, going back over to some of the other reports. So Fed Kashkari obviously mentioned the quiet part out loud, maybe no rate cuts in 2024 if inflation continues to move sideways. So this, again, was from the Minneapolis National Fed President, Neil Kashkari, who basically mentioned that if we continue to see inflation moving sideways, then that would make me question whether we need to do those rate cuts at all. And there's a lot of momentum in the economy right now. If the economy continues to grow as it has, powered by consumer spending, it also raises the question of why cut rates in the first place, and more rate hikes are not off the table, but they're also not likely scenario given what we know right now. So, this is one thing that we have discussed. And, even I remember from last year, there was a lot of comments on my YouTube videos talking about how there's 6-7 rate cuts coming in 2024. And up until just a few months ago, I still had a lot of comments talking about there's the first rate cut coming in March. March came and went. People have been talking about the first rate cut in May. We'll find out if that actually happens. But the idea here is, instead of trying to predict when the next rate cut's going to happen or when the Federal Reserve's finally going to pivot, ask yourself the why. Ask yourself why the Federal Reserve would pivot and shift policy in the first place. Okay, I think that will give you a much better, more clear answer than trying to just predict for the next FOMC meeting, and that's when the next Federal Reserve cut or the rate cut's going to be, right? Because at the end of the day, nobody really knows. So it's a much better question to ask why the Federal Reserve would cut in the first place rather than when they would cut in the first place, right? So I'll tell you why. They'll cut when they are confident that inflation, of course, is moving down to 2% or is already at 2%. And there are signs that unemployment is becoming a bigger and bigger issue. Until that happens, they have no reason to actually pivot because economy is strong, unemployment's strong, and inflation's not near close to their target, as we already know. So, of course, next week we've got the inflation numbers coming out. I've already gone over the consensus expectations, but if you go over to the data, so consumer price index over here, we're going to go over to the charts. And if you take a look at, of course, how inflation's performed, it's been stagnating a little bit more sideways. So all items CPI, you'll notice that it's been at 3, 3.2, 3.7, 3.7, 3.2, 3.1, 3.4. It's been hovering in and around that 3 to 3.7, 3.8% level for quite a few months. It's been almost a year. And then if you compare that to core CPI, you'll notice that it has been trending lower, which is a good thing, but it's been doing that at a very, very slow rate. It's been going down at a very, very slow rate from 4.1 down to 3.8%. So again, the real question is, why would the Federal Reserve pivot policy and start cutting rates if inflation's not down to the Fed's target and economy and unemployment continues to be super strong? So as I mentioned in one of my previous videos, and this was from last year, I talked about this, that the Federal Reserve and FOMC is kind of punishing the economy for being strong. They're punishing the economy for doing really well. And that is a crazy concept, but that is the reality. If the economy continues to do well, and if it's growing at a very rapid rate and unemployment's strong and labor market's very tight and there's a lot of job openings and people are employed and earning a lot of wages and wages are going up, they have no reason to start cutting rates because there is no sign. There is literally no sign of a potential recession or increasing unemployment because the Federal Reserve, the only way they would be shifting policy is to fix something. And right now there is nothing to fix because there is no problem. There's literally no problem because of how strong the economy and the labor market is. So again, the question isn't when the Federal Reserve is going to cut rates. The question is, why are they going to cut rates? And right now they don't have a compelling reason to do that. And that's exactly why Kashkari and a few other members who are a little bit more hawkish are saying what's actually on their minds. And Jerome Powell, of course, he's mentioned that there is some cuts priced in 2024, even in the SEP. Some of economic projections have kind of jotted down a few cuts in 2024. Of course, time will tell if you actually do see that. But that all of that needs to come on the back of significantly lower inflation as it continues to trend lower. Core inflation, more specifically, if it dips below 3%, I think the Federal Reserve will feel a lot more confident that they can now start cutting interest rates. But it really, really needs to come down fast enough in order for the Federal Reserve to feel confident. But until then, I think we just have to wait and see where we end up going. Now, on the other hand, the 10-year treasuries push higher. So that is, again, a huge problem for the market because we continue to see a significant increase here in the 10-year yields. And we're now sitting at well over 4.4, 4.5%. The higher this thing goes, the bigger the problem becomes for the S&P 500 and the NASDAQ because, again, this is a risk-free rate, which is compared against the earnings yield and the again the multiples on the S&P 500. So S&P 500, think of it this way: why would someone take on risk to make less? Right? That's not rational investing. So if the 10-year treasuries of the bond market starts to offer us 4.5%, 5.5%, 6.5% yields, there's no reason to be taking on risk to be investing in equities, right? So equities, in other words, become less favorable as the bond market continues to push higher because that is, again, a risk-free rate that investors can generate on a yearly basis, which, again, is very attractive, right? 4.5% is no joke. It's actually a pretty good return. And the higher it goes, the less attractive equities become relative to bonds. That's why they start putting a lot of pressure over on equities. So those are some things to keep in mind. I already did a full technical analysis on the S&P 500, the NASDAQ, and of course the big tech stocks here. But next week we've got lots of things coming out. We've got lots of members talking. We've got inflation numbers, and of course, earnings season is just getting started. So lots to unpack and lots to discuss for us in the coming weeks. I will be live for both CPI and PPI on Wednesday and Thursday here. So make sure that you do tune in on those days at 8:30 a.m. Eastern for those inflation readings. As always, if you enjoyed this video, found it helpful, make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. And again, links to our Discord and Patreon is going to be down below. We'll love to have you on board. As always, happy investing. I'll see you all in the next video.